Thanks for joining us tonight. Sorry for the technical difficulties at the beginning. You know how that goes sometimes. For those of you who don't know me from the bulletin board, I'm Dave Steckler. I've been using HGSI since, let's just say, we were all a lot younger and wore pants that had a lot smaller waistline. And I was taller too. Back in, oh gosh, how many years ago was it? 5 years ago, 5 or 6 years ago, 4 or 5 years ago, several of us were talking, and gee, wouldn't it be nice if we could find an indicator that gets us in when it's time to get into a stock or an ETF, keeps us in during the usual ebbs and flows of a stock or ETF, gets us out at the right time, in addition, doesn't get us in when it's not the right time. And it was, yeah, that would be nice. And if I was 7 feet tall, I'd be the starting forward for the New York Knicks. Well, we looked and really couldn't find anything that met that criteria. So, okay, well, you know, why don't we design something? And a group of us, there were 4 or 5 of us, got together and threw out some ideas. What would we like? And like is very common in these kind of things, it rapidly got A, too complex, and B, it worked great when we back tested it, but fell apart when we forward tested it. In other words, it was curve fitted. So we went back to the drawing board and, okay, let's get this as simple as possible. And we came up with something that worked out really well, and we decided to name it the Bongo. You've got a screen there. Let's keep the SEC happy. Although I'm retired, I no longer work in the business. This is just to keep the SEC happy. Don't believe anything I tell you, and any examples that we show are hypothetical, and it doesn't mean it's going to work that way in the future. Okay, let's talk about the Bongo. As you see, the Bongo was developed by your fellow HGSI users. Now, when I made this PowerPoint presentation, it was originally presented to a non-HGSI audience. So there'll be a couple of things and a couple of slides that'll be like, huh, we already know that. So you'll just please bear with me on that. The nice thing about the Bongo is that it very readily signals upward and downward biases of the market. Many of you are probably familiar and may have even read his books, Dave Landry. How many of you have heard or used some of Dave Landry's stuff? Okay, George, I can't see any answers. George, are you there?
There are several people coming in with yes. They've heard of Landry.
Okay. All right. Thank you. Well, Dave has a little technique he calls the big blue line. And he just looks at a chart and says, hey, look, am I seeing a pattern of higher lows and higher highs? The big blue line's pointed up. Am I seeing lower lows and lower highs? The big blue arrow is pointed down. We were kind of looking for the same thing. Something that very easily would say we're in an uptrend, we're a downtrend. And that's what one of the things that the Bongo shows us. The Bongo can also be used to determine the bias of individual stocks, of ETFs, and in HGSI, we can apply the same indicator to sectors, to industry groups, market indexes, etc. You're not just limited to stocks or ETFs. And the Bongo may be used either as a daily or a weekly signal. And which one you should use, we're going to talk about in a few minutes. Keeping in line with the maxim of keep it simple, stupid, or as I like to tell people, no brains, no headaches. The less I have to think, the more likely I am to make money in the market. we went down to what's the minimum we need to do to find an effective way of telling us what the bias of the market is. And we used 3 Wilder relative strength indicators: the 8-day, the 14-day, and the 19-day. This could also be the 8-week, the 14-week, and the 19-week if you're using weekly data. We also use a 9-period simple moving average, 9-day on a daily chart, 9-week on a weekly chart. Now, many of you, if not all of you, are familiar with the concept of relative strength. William O'Neill was the person who really brought relative strength into the forefront of technicians as well as non-technical analysis. Pretty much anybody who read the Investor's Business Daily was familiar with the concept of relative strength. The RSI, the Relative Strength Index, is not relative strength. Relative strength just measures the performance of stock A versus everything else in a database. The Relative Strength Index is a rate of change oscillator. It compares the price of a stock or an ETF to itself. It does not compare the relative performance of one stock to another. The RSI can be used to spot negative and positive discrepancies, that is, divergences with price. And it can also be used to define if a stock or an index or an ETF has reached an oversold or overbought condition. Now, many of you probably have an RSI indicator on a chart or charts that you use. The traditional levels with the RSI are it's overbought at 70, it's oversold at 30. It's an oscillator. Well, the Bongo does not use the traditional 70-30 overbought, oversold levels. Now, the key to the Bongo, and this is tying in with the big blue arrow, what's the trend? An 8-day, and I'm going to use the term day instead of period or weeks. An 8-day RSI is faster than a 14-day, meaning it's more sensitive and will make changes in its values faster. A 14-day is faster than 19-day. Think of this like moving averages. A 10-day moving average is going to be a lot more squirrely than a 50-day moving average, which will move faster than a 200-day. Now, you've probably also have heard of the term the golden cross or the black cross. When the 50-day moving average moves above the 200-day, that's called the golden cross. When the 50-day moving average falls below the 200-day, that's called the black cross. It's the same principle. We want these 3 RSIs to be in a proper order. We want the 8-day have a higher value, and we'll see it in a chart in a minute, but you can just visualize it in your head. We want the 8-day to be above the 14-day, and we want the 14-day RSI to be above the 19-day RSI. As a confirmation that price is moving in the right direction, because we want to avoid whipsawing, we want today's closing price to be greater than the 9-day or the 9-week simple moving average. So let's put it all together. When we've got the RSIs in the proper order and the closing price is above the 9-bar SMA, we have what we call a Bongo yes. On HGSI, in the Bongo ribbon, that turns green. And when you're in the warehouse, there is a data field for Bongo, and it'll just say yes or no. We exit just the opposite. When the RSIs are in the reverse order, the 8-day is below the 14, and the 14-day is below the 19, and that's very important, and the closing price is below the 9-bar SMA, then we have our exit. We have a reverse order. We have a closing price below the 9-bar SMA. That's a Bongo no. In HGSI, the Bongo ribbon turns to red, and in the warehouse field, it will say no. So it's about as simple as we could make it. If two conditions are met, 8 above the 14, 14 above the 19, and the closing price is above the 9-bar SMA, we're in go mode. We're yes. And if it flips down to the downside, the 8 below the 14 below the 19, and the price below the 9, we get out. We exit. Now, many times you run into situations where the 8 is below the 14, but the 14 is still above the 19. Whatever the preceding signal was, if it was already in a Bongo yes, and now let's say the stock starts to pull back for a few days, and the 8-day RSI or 8-week RSI falls below the 14, but the 14 is still above the 19, even if the closing price is below the 9-bar, the signal stays Bongo yes. Both conditions must be met for an entry as well as the exit. It's very important, because a lot of times I'll get emails from people or people ask me questions, but look, the price is falling down. Why should I wait? Well, we're going to see in a few minutes examples of why you should wait. When it comes to charting a Bongo, you use any charting application that can alert you to when the RSIs are in the proper order and the closing price is above the 9-bar SMA. And I'm going to show you two slides charted with Bongos, one using HGSI and the other using TradeStation. Excuse me. You can do that in Thinkorswim or any application that will let you chart multiple RSIs and chart a simple moving average at the same time. The nice thing about HGSI is it'll do it automatically for you. All you got to do is give it the list of stocks you want it to check. It automatically tells you whether or not you have a Bongo yes or a Bongo no. You don't have to sit there looking through 50 or 100 stocks or ETFs. Okay, where's the 8, where's the 14, where's the 19, where's the moving average and the price, etc. HGSI automates the whole thing for you. And that's one of the beauties of HGSI. Okay, here is a chart of Apple Computer on TradeStation. Okay, this is from a couple of years ago, as you can see from the dates, 08 and 09. On the top, I've got the price of Apple. The moving average line there is a 9-week simple moving average. You notice at the top of the screen, it says Apple Weekly. In the middle of the screen, I've got the 3 RSIs, the 8, the 14, and the 19. And here is the ribbon. Now, on TradeStation, the ribbon's a little different. On HGSI, all we have is a green or a red, a go and a no. At TradeStation, we also have a yellow. Yellow lets you know not all the conditions are met, but it hasn't reversed. So, for example, in here, we went from green to yellow. Now, let's look at the moving averages. Excuse me, let's look at the RSIs. First, does everybody see my mouse pointer? George, we getting responses?
Yes, they're saying it.
Okay. There's your 8, there's your 14, there's your 19. So in this period here, I guess it's September, November of 09, the 8 fell below the 14 and the 19. And I think there might have even been at one point where the 8 was below the 14 and the 14 was below the 19. But when we look at price was still above the 9. So we have a yellow here telling us not all the conditions for a green, for a go are met. Be aware of this, but it's not red yet. And this ties in with what I was mentioning just a few minutes ago. When people ask me, hey, look, the RSIs have reversed. Why don't I just exit the position then? Well, if you exit the position then, and that you see this big weekly black bar here, That ties in with this here. Well, if you exited then, you might not have known where to get back in. I mean, the Bongo tells us, but one of the ideas behind the design of the Bongo was let's minimize portfolio turnover. It's one of the reasons why we like the weekly Bongo, and we'll talk about that in a little bit. But we wanted to keep the portfolio turnover down to a minimum. Reduces your tax implications if you're in a taxable account, reduces your trading costs, etc. All stocks, all ETFs, they're going to go through periods where they pull back. That doesn't mean you necessarily want to get out. Okay. Here is the Bongo on HGSI. We've got, here the ribbons are on top. We've got the price on the bottom. It's the same Apple chart. Here's the 9-day. Now this is a daily chart. That's a weekly chart. This is a daily chart. We've got a 9-day simple moving average. We have the weekly Bongo ribbon up here, and below it, it says Bongo signal. This is the daily Bongo. You notice that they're not the same. Okay, but you can see the layout is similar. It's very simple. We've got a moving average, we've got price, and we've got the ribbons. Okay, how well does the Bongo work? The Bongo ultimately is a trending system. It gets you in, hopefully early, with a trend, and keeps you in, keeps you long as the trend is moving higher. Or as Ian likes to say, lower left, upper right. Okay? In a choppy market, either won't get in at all or won't perform as well. We were designing the systems, the Bongo system, back in 2009. It was 3 years ago, 3.5 years ago. We did a backward test, walk forward test with 20 high relative strength stocks selected in March 2007 and March 2009. Does anybody know why we picked the stocks from March 2007 and March 2009? I can't see your answers, George. You'll have to tell me.
And nobody's indicating anything there.
Of all of you who are online, how many of you have attended the seminar in Palo Verdes?
Several people.
All right. Those of you who had attended, what is it that you usually do on the last day?
No response.
Okay. Usually, okay, everybody, what high beta, high relative strength stocks do we think are going to do well over the next 6 months? And all sorts of stocks are thrown out, and the list is narrowed down, and that's the list for the following 6 months. Well, of the 20 stocks we selected to do the backtest on, it came from the stocks that were picked by the seminar attendees in March of 2007 and March of 2009. What happened in March of 2008? What happened in 2008? Okay, did we backtest 2008? Yes, we did, with the stocks that were selected for 2008. And if you recall, 2008 was the year that the market we had the market pullback in 2008, and it bottomed. The market bottomed in March of 2009. So 2008, the market was trending down, and almost all of the 20 stocks we tested, as I recall, only 2 or 3 of them during the course of the year ever had a Bongo yes indicator. They didn't work out very well, but 17 or 18 of them never were bought. In other words, the Bongo said, don't go into them. That's the beauty of the Bongo. It keeps you out when conditions are not good for being long, for being in anything. Now, nowadays we've got inverse ETFs, etc. This was before the inverse ETFs were very popular. Okay, for those not familiar with inverse ETFs, they go up when whatever market index it's following goes down. So, for example, everybody knows what's the ETF for the S&P 500? Somebody just type it out. What's the ETF for the S&P 500 index?
SPY.
SPY. The ETF for the inverse S&P 500 index is SH. S like Sam, H like Henry. Okay. When the S&P 500 goes down, it goes up. And of course, you've got leveraged ETFs as well. Well, we didn't test any inverse ETFs because we were just doing the stocks that people were selecting at the seminar in Palo Verdes. So 2008 showed us, the testing team, one of the beauties of the Bongo. It keeps you out when conditions are not conducive to being long any security that normally goes up, that goes up in a good market, down in a bad market. It doesn't do you a lot of good, let me rephrase. Okay, I've got a portfolio and I'm 100% in cash because I'm not getting any Bongo signals, and I've been in cash the entire year, and a one-year CD pays 0.15%. I'm frustrated. Well, it beats losing 30% in the market for the year. So, just put that in your pipe and smoke it, as they say. All right. The time period we tested was January 1 through December 31st of each year. And all the open signals, meaning if the Bongo had been a yes signal at the end of the year, we automatically closed the trade. In 2007, the S&P was up 3.5% for the year. The Bongo return was a little better than 92%, not including transaction costs. Okay, you can see the win-loss ratio was dramatic. It was 4-to-1, 4 wins for every 1 loss, almost 3.82 times. The average gain per trade was 53%, and the biggest loss was, actually the average largest loss was a little over 3%. We had a reward to risk ratio of almost 27 times, which is, phenomenal. And the Sharpe ratio is a way of measuring risk in a portfolio, and the higher the Sharpe ratio, the better. The Sharpe ratio was 7.72, which is virtually unheard of. Some of the highest performing mutual funds will only have Sharpe ratios of like around 2.5. And the average holding period was 16 weeks. Now, keep in mind 2007 was a very good year. The market pretty much, let me rephrase, 2007 was not a very good year because the average, the return of the 500 was only 300%, but the Bongo stocks, high relative strength stocks, they basically never looked back once they started taking off, and you didn't have to turn your portfolio over very much. In 2009, remember, the market bottomed in March of 2009 and had a hellacious remaining 9 months of the year. And even with the losses from the first three months of the year, the market was still up better than 23%. Not bad. 23%. There isn't anybody who wouldn't take that every year, year after year. Thank you very much. But the Bongo was up 134%. The win-loss ratio was four wins for every loss. The average gain per trade was 105%. The average loss was 2.6%. The risk-reward ratio was 48. We couldn't calculate the Sharpe ratio because mathematically it couldn't be calculated because the returns were so high. And the actual average holding period was even longer, 19 weeks. Okay, 2008, because the market, the big blue arrow was pointing upper left to lower right, the Bongo kept you in cash. If you followed the Bongo signals, that portion of your portfolio was in cash virtually the entire year. And you can't ask for anything more than that. Now, the Bongo also works well with ETFs or ETNs. You're never going to have the, I shouldn't say never, and I'm excluding leveraged ETFs. It's almost impossible for an ETF to perform as well as a high-performing stock. By definition, an ETF is a portfolio of many securities, like a mutual fund, whereas a single stock is just a single stock. Nonetheless, ETFs are becoming more and more popular for reasons that are beyond the scope of tonight's presentation, but I'm sure everybody here is familiar with ETFs. So, let's, can we use ETFs or ETNs with the Bongo? And the answer is yes. First, you want to select ETFs with a high relative strength. Okay? If an ETF isn't moving much, if the relative strength rank is low, you're going to have Bongo no's, so you might as well eliminate them. Well, with HGSI, in a matter of seconds, you can find your list. You go through all the ETFs, and we can do this later, and find me all ETFs with a relative strength rank of 90 or higher. In the time it took me to say that, you can do it in less time on HGSI. So there's your list. There's your high relative strength ETFs. When we did our back test, we used an RS, a relative strength rank of 95 or better, an average daily volume of 50,000 shares. And we picked the following ETFs: 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15 ETFs. Some are market indexes, some are foreign like EWO and EWT. We had some commodity indexes like oil and USO. And I back tested them basically April of 2009 through April of 2010. And just like we did with the stocks, at the end of the time period, all the open signals were closed. The S&P that year returned 44%. The Bongo was 50%. Not that much better. We had a good win-to-loss ratio. We had a good average gain per trade, a small average loss. The turnover was typically 2 to 4 trades per ETF per year. Now, on the one hand, you can look at this and say, well, gee, it did a little better than the S&P, but there was risk involved, and I could have just gone into an index fund, and I would have made, about 44%. Well, my answer to that is that's true. Did you know that at the beginning of the time period? Did you know on March 27th of 2009 the S&P was going to return 44% over the next 12 months? We knew from the testing in stocks that the Bongo, by the nature of its construction, will give us, for the most part, positive returns, because it's identifying stocks and ETFs that are going higher, because we've got the RSIs in the right order and we've got price above the 9-bar symbol moving average. Nonetheless, the purpose of this was to show, because the question had come up at the time, all right, it works great with stocks, but I like ETFs. Does it work with ETFs? And the short answer is yes, it does. Okay, now, it's very easy to scan for bongos using HGSI. And let me ask this. How many of you use HGSI? Or let me rephrase. Do any of you use HGSI to scan for bongo stocks, specifically for bongo stocks?
Lots of yeses.
Okay, good, good. Then this will be, as I said, when I made up this PowerPoint presentation, it was for a non-HGSI user crowd, so the next slide or two will be old hat to you, but it doesn't hurt to review it. We've got a filter to scan for bongo stocks or bongo sectors or industry groups. You select the filter, you edit it. If needed to, you can change your minimum volume, you can change your minimum price, and you add the filter that you want. In this case, the daily and weekly yes. And keep in mind, these slides were made a few years ago, and there have been some changes in HGSI since then, but pretty much it still looks like this. And here's your filter, the filter that we used at the time, a minimum price of 5, minimum volume of 40,000 shares, bongo daily or weekly are both yes. We wanted to avoid preferred stocks, and voila, here's your list. You know, in this case, these were all stocks. Let's say those of you who are doing this, this is old hat. Okay. This was just to show people, the non-HGSI people, how you can go from the warehouse view, and by double-clicking on the stock, the line that's highlighted in blue, it brings up the bongo chart. Okay, and here too, this, I mean, we all subscribe, so this really isn't, this isn't for us. So, okay, so let me summarize. Then I'm going to take questions, and then we will go to HGSI itself. I updated just before I got online, so you know, you can throw out some symbols and we can look at them and see what we see. The bongo puts you in line with the directional bias of whatever it is you're trading, whether it's stocks, ETFs, or both, whether you want to look at the market, the broad market indexes, sectors, industry groups, etc. It will put you long in up markets, and it will send you to cash, or if you want, you can go short in down markets. Our group came up with this 3.5, 4 years ago. I have yet to see anything that is as, and I know this will sound corny, but I have yet to see anything that is as elegant in its simplicity as the bongo is. You know, the first question in everybody's mind is, I mean, look, we all know it's easier to swim downstream than upstream, okay? We want the wind at our back. If the market is falling off a cliff, it's a lot easier to stay out of the way than it is, ooh, let's find some stocks that are going up today while the market's down 300 points, okay? So the first question, and this is part of top-down analysis, is what's the big picture? What's the direction of the broad market? The bongo helps you there. And then you narrow it down. Okay, I want to find the best performing sectors. The bongo can help there as well. Okay, the bongo will tell you which sectors are green, which sectors are moving lower left, upper right, which industry groups are doing the same thing. And just narrow your filter down and down more, from broad market to sectors to industry groups to stocks within those industry groups. If you have any questions, of course you probably all know my email address from the bulletin board, from the email list, I mean. There's my phone number. Many of you know, because I post the link every day. I do an ETF blog, which I very much enjoy doing. Occasionally I'll discuss the Bongo in the blog. Periodically I'll discuss HGSI on the blog. Okay, let us move to questions. Who has questions? Now what you'll do is you'll type them out and George will read them to me. I cannot see your questions.
Dave, there's several in the chat box for you right now.
Okay, I'm not seeing anything. I'm not seeing anything in the chat box.
Okay. Then I will come at them for you.
Okay.
Please take a look at ROST, R-O-S-T, and ERX and make comments.
Oh, okay. All right. So let's go to HGSI. Hello. Come on. All right. Here is this is real. This is data current through today. This is the HGSI. Sorry. This is the Bongo chart, the weekly, and the daily. Oh, one thing I forgot to talk about, but I will talk about during this question and answer period, is should you use daily or weekly Bongos? So the first one was ROST. I need to move this. Okay. First, since I changed screens, is everybody still seeing my screen? You're seeing HGSI with ROST, Rust Stores.
Yes, they are.
Okay. No question, Ross, and this is the daily chart of Ross. Ross has been going higher, lower left, upper right, been pretty choppy since June. The weekly Bongo is the top ribbon. It's been red since the end of June. The daily has gone from red to green, red to green. That is a nice segue into the question, and I'm going to discuss Ross further in just a moment. It gets into the issue, though, of when you're using the Bongo, which should you rely on? The weekly chart, the daily chart, or both? When we did the back test in 07 and 09, we tested both daily and weekly Bongo signals. Now, we didn't mix them. It was either all weekly or all daily. And we found that uniformly for almost all the stocks in the 2 years we tested, the weekly only Bongo gave us a significantly lower turnover and a significantly better return. And the bottom line is you weren't stopped out and gotten back in. For example, this is the daily Bongo. If you got out here on June 25th, you were out until here on July 5th. Well, you got out, whoops, you got out here. The close was 65.42. You got back, and I'm just using the closing price. You got back in here at 67.19. So not only did you have 2 commissions, but you got back in at a higher price than where you got back out. Now, the weekly Bongo also went no at this time, and it stayed no since then. Now, the close on this day was 61.67. And Russ closed today at 68.29. Gee, I left, 6-7 points behind. I left it on the table. So should I use the weekly or the daily? All right, well, that's kind of sort of up to you. I know from the test that we did that the weekly at the end of the day, or the end of the year, I should say, is going to give you a better return. Yes, you will leave some money on the table. Eventually, if it keeps moving in this direction, the weekly Bongo will go green again. And it went green. Now, the daily went green here. It got you out here, and then went green again here. So you might have made a point or two. The weekly kept you out over that time. Just based on what the Bongo is telling us, it's saying type 3 and type 4 investors, right, that's HGSI terminology for people who have a life, don't want to sit in front of a quote machine all day long, want to go on vacation, go to the golf course, go to the movies. They have a low or lower risk tolerance, and a high and a low, what I call a low pucker factor. Just follow the weekly. Okay. Another alternative is you want to get in faster, stay in longer though. You could use the daily as a signal to get in, and then use the weekly as your signal to get out. Okay. Now we don't have a good example of it here because this is the only first time where Ross went Bongo no on the weekly. We'll see some other stocks where it's a better example. But based on what the Bongo is telling us, type 3 and type 4 investors should stay away. Type 1 investors and 2 investors, well, you can see it's pretty choppy because the Bongo daily on every couple of weeks flips from green to red. So, it's your money, your choice. George, what was the other stock, please?
The other one was, where did it go here? I lost it for a minute. Oh, ERX. Thanks, Lou.
ERX. Okay. We did not, when we designed the Bongo, we specifically did not test leveraged ETFs. That notwithstanding, there's no reason why you can't use leveraged ETFs. And this chart, in fact, will give us an example of what I was just talking about a few minutes ago about using the daily to get in and the weekly to get out. The weekly Bongo went yes. The weekly Bongo went yes. Come on the 13th of July, and has been yes since then. That's bullish, and it's made a heck of a run since then. It closed at 39, and today's close was at almost 49. So it's 10 points on on a $40 stock. Not bad. The daily went yes back here at the end of June at 36.72. Better price than the weekly, which didn't go long until 40.5. So this is an example of, well, okay, I use the daily to get in, and should I use the weekly to get out? Let's use a different time period. And I need to move things around a little bit. Okay. If we look here, if we look at this period, well, if you were just going by the weekly, you'd have been long all this time. Okay, which does illustrate a point. Remember, one of the features of the Bongo is it lets you ride out the normal pullbacks in a stock's life, keeping you in line with the longer trend. You would have been in, you'd have been out, you'd have been in, you'd have been out, you'd have been in, you'd have been out, you'd have been in, you'd have been out. 1, 2, 3, 4, 5, 6, 7, 8 trades versus 1, 2 trades. Okay. But just for illustration purposes, let's say, for example, you're first looking to get in. You first found ERX on this here, back in the middle of January, and then a couple of days later, Bongo Daily went yes. We knew it was already Bongo Weekly green, but it went Bongo Daily green. Okay, we'll get in here. And even though the daily went red, we'll stay long because the weekly is yes. All right, so that's an example of using the daily to get in, using the weekly to get out. You could do it the other way too. You can use the weekly to get in and the daily to get out, although you're going to get knocked out a lot faster. Move these back. So based on the Bongo and just the Bongo, this is looking very good. Now, one of the things that the Bongo is useful for is telling you when to get in. But one of the things we found out, it was very important to maximize your return. You need to get in when the Bongo Weekly, now I'm using Bongo Weekly, you need to get in when the Bongo Weekly first turns green. In other words, if you're looking to get in now, well, that's 10 points ago. Okay, 40.46 versus 49.73. That's 9 points ago. Obviously, you'd rather get in at 40.5 than 49.5. If you're not in ERX, should you first get in now? No, I wouldn't. Now, maybe other indicators say it's okay to get back in, but the Bongo is saying don't. The signal came too long ago. If you already own ERX, is the Bongo saying you should stay long? The answer is yes. Both the daily and the weekly are green. Now, one thing you can use, the divergence between the daily and the weekly. If the daily goes red and the weekly stays green, stay long, maybe you want to raise a sell stop or place a sell stop. If the weekly goes red, just get out. It doesn't matter what the daily Bongo's doing. If the weekly goes red, just get out because the trend is turning against you. Any other stocks you'd like me to look at?
I don't see any other ones here at the moment. Well, yeah, they're coming in now.
Okay.
I'm going to give you several at the same time. Maybe you just want to jot them.
Yeah, that's what I'm going to do.
Okay. Apple. CL.
Okay.
TIVO.
Tivo. Okay.
DDD.
Triple D.
Triple D.
Oh, diners, drive-ins, and dives.
You're good.
Okay.
CHK.
CHK.
STEM.
STEM. Okay, that's enough. Let's just hold it right there for now.
There's just one more here. TQQT. Triple Q. TQQQ.
Yeah, the leveraged cubes. Okay, let's start with Apple. Yeah, since we were talking about Apple before. Hang on a sec, folks. I need to take my headset off and turn the light on in my office. I'll be right back. Okay, I'm back. Apple had a great run early this year on the daily chart. I mean, and that's solid green on the weekly. And the Bongo got us out in late April. Didn't get us out as early as the daily, But there's actually wasn't that much of a difference in price because even the daily got out, price went up. The daily went to no at 599 and a half, and the weekly went to no at 573. Percentage-wise, it's not that much difference. We're now back in green. We have both daily and weekly, which is good for green. When the Bongo Weekly went to yes, Apple closed at 615.70. It closed today at 619.86, $2 difference. Given that both daily and weekly just went green or recently went green, would I go long here? Yeah, you could. You're not getting in too late in the game. The fact that price hasn't changed much is not as important to me as the fact that the signal went green, the weekly signal went green recently. Let me just change to a weekly chart. And you can see the weekly signal went green on the 3rd of August. And today is the 8th of August. So it's just a few days ago. So yeah, based on the Bongo, it's a good time to consider going long Apple. Again, I would not recommend using the Bongo as your sole indicator. It's a gross, I don't mean that in a negative, but I mean in terms of large. It's a gross indicator of directional bias. It's not designed, it doesn't fine-tune entry and exit. There are plenty of other indicators in HGSI you can use to help fine-tune your entry and exit prices. Remember, Bongo is a directional bias indicator. Having said that caveat, this doesn't mean if you went long now, Apple wouldn't come down. It could drop 5 points, 10 points, 20 points, and the weekly Bongo might stay green. But still, from a strict Bongo analysis, it's not a bad time to get in. Okay, CL. Colgate-Palmolive. It's pretty much been Bongo green since, weekly green since February. A little period here where it was no. And you can see what I meant by the turnover is low with the weekly. I mean, this is February, beginning of February, and it went to no in June. So February, March, April, May. It basically stayed long for 4 months, give or take a day. Kept you out for a couple of weeks, for a couple of days rather, and got you back in again. Would I get back? Would I buy it now based on the Bongo? No. I mean, the Bongo weekly went yes 2 months ago at 100. You know, and okay, it's only close today, only 105. It's not that much. It's only 5% difference in price, but it's a long time ago for the Bongo. Plus, the daily just went red. So, again, if you own it, if you're already long, stay long. Weekly, the Bongo weekly is showing it likes to stay green, and that's a good thing. Colgate and Palmolive, it's good to be green. I'm sorry, Colgate and Kermit, I meant. It's good to be green. Okay, Tivo. Everybody knows what Tivo is. Okay. Tivo just went Bongo weekly green. After bottoming at 779 and it got up to 924, you know, it had made a 20% move. Now it's pulling back a little bit. One thing I don't have on this chart, and it's not a bad thing to put on, is a 200-day moving average. As a rule of thumb, and now I'm just following Larry Connors here, you only want to go long something when it's above its 200-day moving average. Okay? problem is you can have a Bongo green even when something's below its 200-day moving average, and it can still make a nice move. All I'll say is it's your money, it's your choice. I'm not saying I don't go long stocks or ETFs below the 200-day. I usually don't, but occasionally the chart's just too compelling, and I'll do it. Based on the Bongo, you've got a daily and a weekly green. If you already own Tivo, you definitely want to hold it. Obviously, it broke the downtrend. It broke the downtrend back in late July, couple of weeks ago, and it's made a nice move since then. So, moving on to diners, drive-ins, and dives. This is about as nice a Bongo chart as you're going to find, and this is a textbook example of why we like the weekly over the daily. You went long in the middle of January, and you've been long for the whole time since then, versus I'm not even going to start counting. 1, 2, 3, 4, 5, 6, 7, I don't know, it's over a dozen. A dozen trades on the daily, getting in at the green and out at the red, and into the green and out of the red, and half of those you probably got back in higher than where you got out, as opposed to buying it at $17.10 and it closed today at just under 40. It's more than doubled in 8 months, 7 months, all right, versus trading it a dozen times or more. This is, one of these, why even debate it? You've got a dynamite Bongo weekly green. Just stay long. Would I first buy it here? Hell no. Doesn't mean it won't go to $80. For those of you who own it, I hope it does. Tomorrow. But it's been 6 months since we got a Bongo weekly green, and remember, this is key. You want to get in when the Bongo weekly first fires off. You want to get out when the Bongo weekly first fires no. Okay, next is Chesapeake. Chesapeake has been in the news. Lately, they've been selling off their assets. Ol Aubrey has gotten his fanny spanked by the board and by the market for his shenanigans. The Bongo weekly went green 2 weeks ago. The daily's been flipping around. It went green at 1846. It closed today at 1990. Maybe not too late to buy. May not be too late to buy here. If you already own it, one thing to keep in mind, this is not Bongo, but I couldn't help but see this. You've got a double top here at around 20 1/4. There's going to be resistance there. So if Chesapeake pulls back, towards the 9 moving average, but the Bongo weekly green stays green, that might be a good time to buy it. Let's look at STEM. Stem cells have a nice Bongo green weekly here at 83 cents. FYI, we did not back test with penny stocks. They just get jerked around too much by scam artists as well as people who were just playing games with it. So I really can't comment as to the validity of the Bongo here. It's just, I mean, for goodness sake, the stock has doubled, but it's a penny stock. And TQQQ. The leveraged cubes. This is similar in concept to ERX. We're leveraged. It went to the Bongo Weekly Green 2 weeks ago. It's made a nice move since then. It went from 51.42. It's at 55.40, so it's moved up about 7-8%. The nice thing is the daily went green the same day, but given that it has been a couple of weeks and it's already moved 7-8%, maybe a little too late to get in now. But if it pulls back a couple of points from here and the weekly stays green, that may be a good time to enter. So we've looked at 9 or 10 stocks and a couple of ETFs. You can see that the Bongo, it still works. I mean, that's the bottom line. Here's the SPY. Okay, let's look at the SPY. We had a Bongo, now, I mean, the daily since when? Since April has been kind of all over the board. And you can see the SPY, you know, it's, look, in April, the SPY was 139.86. Yesterday, it was 140. I mean, on the one hand, you can say in April, May, June, July, in 3 months, it's gone nowhere. On the other hand, if you brought it down here, you know, you made a nice return. That's not the point. The Bongo kept you out during the downdraft, and then it got you back in. The daily would have gotten you in here. Yeah, but it would have knocked you out here, back in, back out, back in. This is telling us for now the market still looks like it's going forward. And by pullbacks. When you look at a broad index like the SPY or the cubes, and you've gotten the cubes the weekly went green much more frequently. Excuse me. With this directional bias information, you can use that to tell you, okay, obviously you want to buy low and sell high. If your favorite stock is pulling back and the broad market is still Bongo Weekly yes or green, you have the wind at your back. You're swimming with the tide. Buy pullbacks. I mean, that's classic Larry Connors stuff. And if it's against you, like in here, you know, either short rises or just stay the heck out of Dodge. Okay, are there any other questions on the Bongo that I can answer for anyone?
Yeah, there's a few more here, Dave.
Okay.
Why not include the 9 DMA as signals to enter or exit?
They are. In order to have a Bongo yes, you need the 3 RSIs in the proper order, and the price has to be above the 9-day moving average. For the exit, they have to be in the proper downside order, and the price has to be below the moving average. Was that your question? Maybe I didn't understand your question.
That's exactly the way it's phrased here.
Okay. Yeah, you need both conditions for a Bongo no. That is, the RSIs have to roll over to the downside, be in the proper downside order, and the price below the 9-day. Let me ask this. Were you asking the question, could you just use a cross below the 9-day moving average as an exit, even if the Bongo itself is still green? Was that your question?
If that comes in, I'll pass it to you, Dave. We can go to the next one.
Okay.
What other HGSI tools do you use to help you decide to take a trade after a Bongo signal?
It's not an easy question to answer. First, everybody is different. What fits my risk parameters is not the same as what fits your risk parameters. What works, in other words, I'm trying to say is what works for me doesn't necessarily work for you. Some of the tools that I use are I want to change views because that'll help answer the question. One of the tools that I use is, where'd it go? Here we go. And I've blogged about this, I created short and long synthetic indexes using ETFs. Hang on just a second. Sharon, give him a dental stick, please. Sorry, folks. I got 2 4-month-old puppies, and they're playing downstairs. I created a long and a short ETF, a synthetic index using ETFs. And those of you who read my blog regularly are familiar with this. These are Bollinger Bands. The blue are the standard plus or minus 2 deviations. The red is plus or minus 3 deviations. And this is the 4-day simple moving average. This is a short index. When it's oversold, and down here's the S&P, when it's oversold, it means the market has been going higher for too long a period of time. Too long is in quotes. Too long a period of time. As a good rule of thumb, when the short index hits the lower Bollinger Band, the market pulls back. So even though we've got Bongo green, Bongo weekly yeses on the cubes, on the S&P, a synthetic index made up of these ETFs is saying the market's gone up too far without pulling back. This is a tool that I rely on in conjunction with the Bongo. Again, this is a directional bias indicator. In this case, even though the Bongo was saying stay long, this shorter term indicator is saying the market is more likely going to pull back from here than it is to keep climbing. But let's say we're at a period where the market's going down. When the short index is going higher, it means the market's going lower. Okay, I use indicators, and I'm not talking filters now, I'm talking about indicators. I'll use indicators like stochastics, like RSI, moving average crossovers. It's very hard for me to say what I use, because what I use depends upon what's the tone of the market. When the market looks like it's going to roll over, I use different indicators than if it looks like the market is bottoming out. So I apologize for not being more direct in my answer, but I'm trying to be honest with you. It's too complex a question to answer. It's too complex an answer to your question. Any other questions?
Yeah, there's a couple more here. Let's see. What would convince you to buy DDD now? Hey, Dave, I think we lost your audio.
Can you hear me now? Hello?
Yeah, I can hear you now.
Okay. Does everybody else hear me now?
Yeah, yes, it's coming in.
Okay. Sorry, I accidentally hit the mute button on my headset. I mean, this has been a weekly Bongo, yes, since the beginning of January. You know, when the stock was in the teens. Now it's at 40s. What would convince me to buy it now? I would not use this chart alone to determine where to buy it, because pullbacks to the 9 don't mean anything. You can see it trades below the 9 at times. In other words, the 9 bar, the 9-day moving average is not acting as support. If I go to a different chart, and let me see if I can find it. Okay. This is a chart that I've got labeled default. Volume, a directional, a directional movement, which is the DMI. I've got a MACD, a stochastic, and an RSI. Okay, and this is the kind of indicators I watch on a daily basis. We've got a stochastic and an RSI that are both near over or at or near overbought levels. However, the stock has been trending. These are both oscillators. Oscillators are not exactly reliable in trending markets. Now, this is something you want to stick in the back of your head or in the front of your head or put on a piece of paper and stick it on your quote screen. In trending markets, you want to use trending indicators. In non-trending markets, you want to use non-trending indicators. To determine whether a market is trending or non-trending, you can use the ADX. Go to my blog, and in the search window, just put in ADX. And actually, no, you know what? I will find the particular, I've blogged before about how to use the ADX. I'll find it and I'll post the link to the HGSI email list. Obviously, 3D systems has been trending higher. In a trending market, you want to use trending indicators to help you get in and get out. What are good examples of trending indicators? Moving averages are the classic indicator for trending market. MACD is another one. Now, these moving average lines, that's your 200-day, your 50-day, and that's the 17-day SMA. You can see when triple D pulls back to the 50-day moving average, it tends to find support there and move higher. So the long around answer to the question, when would I buy triple D? If triple D pulled back to its or near its 50-day moving average, I'd be a buyer. As long as the weekly Bongo was still yes, and I can almost guarantee you it would be. So this is what I meant by don't use the Bongo exclusively. All right, even if it just flipped from red to green. Be smart. I mean, you'd never put 100% of your money in anything. Don't make your entire decision based on one indicator, particularly a directional only indicator, directional bias indicator only. So triple D, if it pulls back to the 50-day, I'm all over that like white on rice. Any other questions?
Is there TradeStation code for the Bongo?
As a matter of fact, there is, because as you saw in the PowerPoint, I have a TradeStation chart for the Bongo. So yes, there is. And I will post that on the bulletin board as well. Any other questions?
I think that's a wrap, Dave. There's probably a few items here, but...
Okay, one last comment. I don't know, I don't believe Thinkorswim has a Bongo indicator, but that's really not that important, particularly the Bongo Weekly. You think of Swim's a real-time program, a real-time quoting program, a charting program. Bongo Weekly obviously issues a signal once a week. So HGSI is perfect for that. Perfect for that. Okay, if anybody has other questions, you've got my email address, you've got my phone number. Later, or not tonight, but tomorrow, I will. Now George has the PowerPoint presentation, which he'll put the whole thing, you know, on. It can be recorded. It's being recorded, so you'll have access to it, including the PowerPoint. And I'll get you the other stuff out tomorrow. I want to, before I go off, I want to thank the other members of the Bongo team who helped develop it. Dave Gallardi, Jeff Scott, Robert, and there was a fifth person. Unfortunately, I'm blanking out on who it was. But I did not develop this on my own. I had the help of some very talented individuals, and we worked as a team, and we were glad to do it. So I'll thank everybody for your time this evening, and you have a pleasant one.
Thanks, Dave.
Have a good night. Bye-bye.